You do not want to miss this episode. We're going to dig into the secret asset class of the wealthy, why they have it, and why you should too. Hi, everyone. Welcome to Control and Compound. I'm Darren Mitchell, and joining me is Christina Wyatt. Christina, how you doing today?
Hey, Darren, I'm doing great. How are you doing today?
I am doing wonderful. I'm excited about this one. We talk about this a lot with clients and prospects, and we're really going to dig into how participating whole life through the income banking concept is a wonderful asset class, and we're going to dig into the pros and the cons. But before we get started, Christina, why don't you talk about what you always want to talk about at the beginning of the episode, and I always forget.
Yes. So I just want to remind everybody, if you're listening on your favorite podcast platform, please make sure that you subscribe and leave that 5-star review for us. And if you're listening or watching on YouTube, make sure you like, subscribe, and hit the bell button so you always know when new content is coming out. And don't forget to follow us on social media at Control and Compound. I know it's a lot of asks, but we really do appreciate it.
All right. So let's dig into this. So what we're going to talk about today, we're going to talk about the pros and cons. We're actually going to give an example, which is really cool to show how powerful this strategy is. But when we talk about part of an asset class, we're talking about people with non-registered money. That means not RSP or TFSA money, non-registered money, personal or corporate, but non-registered money. So think of it like this. Think of somebody with a $1 million portfolio and picture that $1 million portfolio as a piece of pie. So if that piece of pie, 70% of that pie is in stocks or equities, 30% is in fixed income, well, those are your asset classes. And what we're really talking about today is maybe that fixed income portion, your 30% of the million, maybe we should roll some or all of that into this participating whole life as an asset class. So that's what we're talking about here. Now, it doesn't have to be $1 million, but it's not somebody with $50,000 in an RSP saying, "Oh, great, how can I use this strategy?" This is people with substantial non-registered money outside of their RSPs. How do we design your portfolio to reflect what a lot of wealthy people do and the advantages of that? So why don't we dig into this, Christina? So the majority of people do have some kind of fixed income in their portfolio. So let's talk about that fixed income and what are the characteristics people tend to have that fixed income for.
Yeah, exactly. So we're talking about reallocating fixed income to in my opinion, better strategy. And the reason for that is because why we keep fixed income in our portfolios is to take advantages of market drops and opportunities as they come up. And a lot of the time that can be in cash or you're using GICs, bonds, those types of things. Well, they have some downside, right? They're not that efficient. That's why we pretty much call it cash in your account on hand. You've got a lot of risk tied to it. So you've got interest rate risk, right? If you're not getting a good interest rate in there, well, now you've run right into inflation risk because your money's not keeping up with it. If you're using those GICs, you're looking at liquidity risk because you can't really access them if you need them right away. You've got opportunity costs. You've got to have it sitting there. It's not really doing much for you sitting there, so that's not ideal. You've got tax risk, right? Like that fixed income, you're taxed just like income, right? It's not an ideal way to be making your returns. So especially in a non-registered account, you're paying tax on that each year as you go. So not very efficient, right? There's got to be a better way, which is exactly what we're going to be talking about more so today, is transferring or reallocating a portion. If not, and I have, clients and individuals that reallocate the entire portion, right? We're looking at that fixed income portion, we're moving it over to the participating whole life policy. So same policy that we use for infinite banking. And yes, we can definitely use it for infinite banking as well when we set this up. But really, we're just talking about the strategy of reallocating and why that's going to be useful. So maybe we should start with exactly what a participating whole life is. We talk about it a lot on the infinite banking side, but maybe a quick little recap.
Yeah. So basically, what we're talking about is this specifically designed high cash value life insurance policy. So what we're going to do is when the premiums goes in, we're going to maximize the cash value as much as we can and minimize the death benefit because it's the cash that we're mostly interested in. And all these companies that we deal with, or the 4 companies we deal with for this particular product, they've all paid dividends since inception, going back to 1846 or 100 years. So every year there's a dividend that grows your cash value and your death benefit. And the term participating really means the fund is owned by the policyholders. So there's non-participating which is the majority of insurance out there. And then there's very few participating whole life contracts. Participating means all the profit of that fund gets distributed to the policy holders, not the insurance company, but the policy holders. We own the fund. The death benefit also grows, so the death benefit's going to grow. So you put money in, you participate in the profits, your cash value grows, your death benefit grows, and it grows completely tax-free. You can access it tax-free, and the death benefit is tax-free.
Exactly. When we're looking at it, it's another wealth bucket in your overall portfolio, right? Just one that's going to do a bit better. So I think we should talk about why using this cash value, using this product is going to be so much better overall than using those fixed income products. So the first one I want to talk about is the competitive rate of return. So inside these policies, like you mentioned, we have that dividend that's been paying 150 plus years. You're typically earning between 5 to 6% sometimes after tax rate of return inside of these policies. That's competitive when you look at what tax rates could go up to down the road, what you're getting for guarantees out there right now. So we do have a competitive rate of return. Big one here, lower fees. So we're looking at between, 10 to 18 basis points when we're looking at the fees between the four companies. That's like a typical mutual fund is around 2.2, 2%, give or take. 0.13% or 0.1%. That's crazy in the reduction in fees that we're going to see in using this strategy. As well, we've got stability and guarantees. So inside of these policies, it's guaranteed to always go up, guaranteed to never go backwards. And you've got that dividend that's been paying 100 and plus years. As well, the super cool thing about dividends is that once they're paid, they're vested. So you can never have a negative year in your cash value. Once that's locked in, that dividend's been paid, that cash value becomes the new guaranteed and you're only going up. So like just those few things I think are very, very important. What are a couple others, Darren?
Yeah. So for me, one of the big ones is liquidity, right? I want to be in control of my money. That's the most important thing for me. I love being in control of my money. That's what the wealthy people have taught me that I studied. And we have absolute liquidity here where you can access 90% of your cash value at any time. So if you have an emergency or an opportunity, you can access that. It's liquid. You also have creditor protection. This is huge for individuals and business owners and real estate investors. And the creditor protection is if you have a personally owned policy and you get sued or go bankrupt, they can't touch your money. So let's just compare that to a regular fixed income portfolio. You get sued or go bankrupt, they take all your money.
Mm-hmm.
If the money's inside an insurance contract like this high cash value participating whole life, that money is creditor protected. Again, you gotta have a named beneficiary in the family and stuff, but it's creditor protected if set up properly. That is massive. Next one is the tax advantages. We talked about it grows tax free, you can access it tax free, and it's tax free at death. We're not kicking the tax can down the road. 3 levels of taxation that we're eliminating there. And I love that I can use this for the short term and the long term. And what I mean by that is I put money, significant amount of money every year in cash value life insurance. And I'm saving for retirement, long-term savings for retirement that I can have a tax-free retirement down the road. But I'm also able to use that money in the short term. So let's say an amazing real estate or business opportunity or stock market opportunity comes along in the next 6, 12 months. I know that I can access 90% of that, use that money in the short term to grow my wealth and my family's wealth but also not affecting my long-term savings plan. So I'm able to use it in the long term and the short term versus most people, they, put their short-term stuff in cash and their long-term stuff in a mutual fund or the stock market or RSP. So they can't really touch that for a bunch of years and the short-term stuff's doing nothing. I'm accomplishing both short-term and long-term objectives with this one strategy.
Exactly. And you mentioned retirement there. So I want to kind of touch on the retirement. I find sometimes when people are in the accumulation phase or, saving in these portfolios, growing their wealth, they don't take the time to think about that retirement side, right? So I get it. The big focus is on the returns, growing that wealth. But what's it look like when we start taking that money out later on? Well, you're taking out from fixed income. Like we've been paying full tax on it, right? Throughout the entire process. And once we get to retirement with this one, well, we've got tax-free loans that we can take out. And we use that retirement strategy all the time, using those tax-free loans, lines of credit attached for 90% of the cash value inside these policies. as well. The neat thing about this is it's an uncorrelated asset, right? So you have market risk when everything's in the market. And if you go to retire and all of your cash is in the market and the market goes down, well, you're in trouble, right? Because you need to take your money from somewhere. You're retired. If you've got to take from a down asset, you're losing. If you have an uncorrelated asset, well, you can take from that uncorrelated asset, let the market rebound on the other side, and you're not taking in a down market. You're not losing those, giving yourself that time to bounce back. That's really important. So we call it the volatility buffer. We've actually got a podcast on it where we go into that a bit further, but having a volatility buffer in retirement, having a non-taxable income that you can draw from, those things are really important. You've also got an estate plan built in there, right? Like we talk about cash, and this is cash that we can use, but there's still a death benefit here the entire time. We've got a permanent policy built in, a permanent estate plan, and this stuff is going to bypass probate. So it's going to bypass probate, no tax there, and it's going to be completely tax-free. That's huge. That's not going to happen with any other portfolio setup that you have. You're going to, it's really important. The fact that it's not hitting that will, it's going directly to your beneficiaries. Huge savings on the tax side when it comes to estate planning as well.
Yeah, I mean, it's just incredible. Like we're just getting started on all the benefits of this cash value life insurance, participating whole life as an asset class versus regular fixed income. Like those are huge. Like it to increase your retirement, to give you that creditor protection, to increase your estate, to bypass probate. Like it makes every other asset you have better because it allows you to take a higher income and all those things. And then some of the other ones from a risk management perspective. Well, we have this death benefit in place, right? Like, what happens if you don't live as long as you expected? What's going to happen to your family? Well, we've got this death benefit in place. Now, I was able to eliminate some term insurance because my death benefit would get to a point where I was able to save that money on term insurance. So just that added benefit from a risk management perspective, it's way better than a margin account, right? So people say, oh, I can borrow against my portfolio, margin account. Yeah. Until the market drops or until there's a call or until they call that or until your job changes. Well, this 90% access against your cash value, that's uncallable. You can take it out. You can pay it back whatever schedule you want. You don't have to pay interest if you don't want to. If you just want to take it out for a year or two, you make all the rules up. You pay it back when, how, and if you want. So it's way better than a margin account. And then probably
not impacting your credit score too. Throw that in.
Oh,
like a margin
huge,
account
yeah.
is going to throw you off, as this is much
Yeah.
better than a margin
this is not
account.
going to show up in your credit report. Doesn't affect that. Banks don't consider it a loan for borrowing capacity. I mean, the benefits just keep multiplying here. And then, one of my favorite benefits is every other asset you have is an or asset. Do I put money into a TFSA or into coaching? Do I put it into real estate or my business? Everything's an or asset. Do I put it here or there? This is truly the only and asset. I put money inside this cash value life insurance as an asset class, and I also leverage that up to 90% and go do real estate, business opportunities, stock market, Bitcoin, whatever your cup of tea is. The possibilities are infinite. But you can literally multiply money, so I can have it in one place, and it's providing a death benefit, and it's also 90% leverage to go take advantage of another opportunity. So it's truly an and asset versus an or asset. So it's I think the benefits are so incredible. Every single person that has non-registered money should have a portion of their portfolio in this asset.
Yeah, absolutely. There's not many, when we look at it, you're talking about the infinite banking side. But if we just go back to straight, again, take out the fact that we can do the and asset and we can make those other returns and we can have our money working elsewhere. If we go back to just straight, and I have an example here, comparison of using what I've got is a comparison of using a 5% in fixed income. So 5% in a registered fixed income environment. So you are paying tax on it every year, right? We're putting $25,000 per year. So in this example we're looking at, we got a 40-year-old male. We're putting $25,000 per year into either a 5% guaranteed every single year investment, or we're putting it into the policy. And I want to show you a couple little comparisons that I think are pretty impactful in your overall planning by using this strategy versus just using that, that fixed income component. So first off, we'll talk about that death benefit. So obviously it's going to win. It's life insurance, right? So it is going to win. So from day one, like we're looking at this, you put 25,000 into the life policy. This person has 467,000 plus in death benefit. On the 5%, fixed income side, you've got 25,642, right? Not so great. Down the road, at age 60, you've got 1.6 million in death benefit with the life insurance. You've got 655 on the alternate investment side, that 5%. So that's pretty huge in the difference. You put 500,000 in, you got $1.6 million death benefit. And it just keeps getting better,
So the death benefit's always going to win with the whole life, right? So no matter where we go, we're going to have a way bigger death benefit, or at death, it's going to win every single time because we have this insurance,
no matter what,
increasing death benefit. The longer you live, the bigger that gap's going to be. We've got this massive death benefit long term. So that's from the death benefit perspective. But what about from a cash perspective? What if I want to, or someone wants us to access or spend that money? How's it compared to the cash portion of the life insurance policy versus the 5% GIC or bond?
Yeah. So for that side of things, and we talk about it all the time when we set up these policies, you are underwater in the first couple years, right? So dollar for dollar, you're not going to have what you put in there. Long term, you are 100% going to be wealthy. And I'll show you the examples. So year one in this, obviously you've got 25,000 in the GIC. In this one, you've got 16,834, right? So you're a bit underwater in this example here, but it's going to continue to grow. And, if we look at year 20 here, you've put 500 in, you've got 744,000 of cash in this, and you've got 655 on the alternate side. And it just keeps getting better, right? Like it doesn't take long for you to have that. And we'll talk about the downsides in a minute, how we are underwater a bit in those first couple years. But long term, because of those tax savings, your cash is going to be better overall. We got a 5% tax-free rate of return. You're paying tax every year on the other side. So obviously, numbers are going to be better long term. So from the cash side, going to win out long term. First couple of years, that GIC is going to have a bit more cash in it, but are we really using it? And keeping in mind too, this is really important, is that when we're comparing these, we've got we're putting 5% into this GIC. We can never touch it. We can't touch that 25 grand, right? On this side, you've got access to 90% of the cash values. It's not going to impact this growth inside your policy, and you're going to be able to go out and use it for your real estate investing or your other investments. If the market dips and you take it and you use it in the market, well, your cash in here is still growing. It's not impacted. We take it out of this GIC, well, that's it. You've stopped compounding and we're starting all over again. And we all know how the penny works, right? So stopping compounding is not good either. So looking at that. And then the last piece that I have kind of highlighted here is the retirement side. Because a lot of people will say, in retire, well, am I going to get the same amount? Can I pull out the same amount out of this in the policy? Like it's life insurance. How am I going to spend this money? It's for when I'm dead. Well, that's not true in this case. With these high cash value policies in retirement, we set up that line of credit that you then have access to, 90% of the cash, you spend it. When you die, we just let the death benefit pay it off, right? And we do let the interest accumulate on there. And what I've got here for a comparison, and it's actually factoring in you not paying the interest, anything out, like you're not paying the interest. It's all
you're accumulating the interest, not paying it.
You're not paying it. You're accumulating the interest. It's all calculated into this. So on both sides, we're pulling close to 73,000 out of here each year. So at, between age 70 to 90, I use, a 20-year time period. You could go 65 to 85 too, but 72,000 a year. Well, what happens with that 5% fixed income is that by age 82, you've completely run out of cash, right? So you put your 500,000 in, you spent 944,000 overall. So 944 has been spent. On my other side, the insurance policy that we've set up, and we've been using this entire time, well, we're going to spend out of that for 20 years. We're going to spend that until we're 90, and we're going to spend a little over $1.45 million. That's what we're going to spend. When we die, we still have $896,000 that's going to our beneficiary, completely tax-free. That means we get a total of $2.35 million that's coming out of this policy versus the $944 that you're going to get for your fixed income. Like that's huge.
That is massive. So just so I understand this right. So what we're saying is if you have a portfolio with some fixed income and you take that fixed income and you put it in this cash value life insurance, and then your example of 25 grand a year for 20 years, the individual themselves, we're not talking at death, the individual themselves are going to be able to spend 1.45 million with the cash value life insurance versus 944,000 with the GIC. So in your lifetime, you get to spend way more, and you also get to leave almost 900,000 to your family tax free. So for a total payout to the family of 2.35 million with the insurance versus 944 with a 5% GIC if you can lock that in for the next 30 years.
And never touch it. So you
And-
can't
and
actually
never
use
touch
it
it.
for fixed it.
So-
You couldn't actually use it.
So before we get into all the other benefits of the infinite banking concept, multiplying the money and leveraging 90%, just as an asset class, it's a lot more money for you to be able to spend in your lifetime, and it's going to help your family. And we haven't even touched into the benefits of using it as the infinite banking concept and multiplying that money. Like, why would anyone not want to do this? I just don't understand. Now, if we think of that, well, how does that make sense? If the cash value is growing at roughly 5% and the GIC is growing at 5%, how are we able to get 2.5, 3 times as much money out to the individual while they're alive and the family? Well, it's tax. All you've decided by using the cash value life insurance strategy as an asset class is you said, instead of donating my money to CRA, paying that fixed income tax every year, I am not going to donate my money to CRA. I am going to keep my money in a tax-free environment so I can spend more and I can leave my family more. So that's really your choice here. Do you want to leave CRA your money, or do you want to leave it to yourself, or be able to spend it yourself and leave it to the family? Those are big numbers, Christina.
Yeah, huge. These are just projections on one. Like, you don't actually have to take a specific amount every year. It's a line of credit. You take what you want from it, right? And you spend as you want. But it does a very good job at showing the comparison when we're comparing, a fixed income investment versus using something like this. Like, it just makes what you're doing better, right? You're already doing great. Wouldn't we want to make it a bit better?
Incredible. I don't know. More money for you, more money for the family, way less tax, all kinds of additional benefits. It's pretty straightforward to me. Now, people are going to be watching and listening to this, going, "Oh yeah, but what are the downsides? What are the risks? What aren't you telling us?" So let's just dig into it, Christina. What are the downsides of doing this cash value life insurance as an asset class versus doing the traditional fixed income?
So I mentioned when we were looking at that illustration that you are underwater for a couple of years, right? You're not. If you have 100,000, you put 100,000 in, you're not going to have 100,000 that same day. You've got access to 90% of the cash value. So it is something that takes a couple of years to get going. But once it's going, right? So a couple of years, if you don't like that, not going to work well for you. The other thing is you're not managing the funds, right? So I, in my opinion, actually think that this is a great thing because you got no emotion in there. And these par funds have, they've only been doing well for 150 plus years, some of them going back to 1847. So I feel like they have a really good track record of making returns. But you can't pick those. You can't pick those funds and decide what that return's gonna, what you're invested in. Some people might not like that. So that would be looked at as a downside. And then the biggest one that it's more of a caution when doing this is make sure that you're working with someone that obviously understands high cash value life insurance. They're going to structure it for you correctly. Like we talk about that a lot on infinite banking too. So they have to be able to structure it correctly. They also have to be working with your investment advisor. So very important that, when I do this, I work with individuals, their investment advisor, to make sure that they know how much I have over here in fixed income that they can reallocate from their overall portfolio and move out into, their equities and their other investments. So it is a team play here where we have to make sure that we're all on the same page, which you should be doing anyways. Like, wealthy individuals have a team behind them that are working, and you should have someone that specializes in this stuff on your team, so that they can work and, make sure that that allocation's all being done correctly. So if not done right, it could be a downside, like we always say, right? Yeah. It wouldn't be great.
All right. Well, those to me are downsides that we can manage, and the idea of having less cash in the first couple of years, well, it's only a part of your portfolio. We're not talking about putting all your portfolio into this. So, I think this kind of answers the question. Yes, the infinite banking concept is an amazing idea, is an amazing concept. And when you implement all the things you can with it, like it's literally the possibilities are infinite. But we do get asked the question, well, what happens if I never actually take a loan from my cash value policy? And I think if you listen to this podcast, you're going to see it's an incredible opportunity, even just as an asset class, if you don't leverage it and do real estate and do investments or whatever. But if you have a non-registered portfolio, it absolutely makes sense to shift a portion of that portfolio into this properly structured high cash value life insurance. Just make sure you're dealing with pros. All right. Great podcast, Christina. Thanks for watching. Thanks for listening. Have an amazing day. Thanks for listening to this podcast. If you're listening on YouTube, please like, subscribe, and hit that bell button. If you're listening on your favorite podcast platform, please leave us a 5-star review and subscribe. And if you want more information, check out our website, controllandcompound.com, and you can sign up for an education session with one of our wealth coaches.